Hello friends. It feels good to receive gifts, right? But do you realize that receiving gift has tax implications? So let's examine what does Income Tax Act has to say about gifts being received. Earlier, there used to be what is called as gift tax. That was donor based. That means the donor, person who gives a gift, had to pay what is called as gift tax. But now the law has been amended, that is, gift tax has been abolished. Instead, the gift received will be treated as income in the hands of the donee, that is a receiver. So now this is donee based taxation. So the receiver of the gift has to pay tax, treating it as his income. Of course, this is applicable to the gifts received by individuals and HUFs, that is Hindu undivided families. Receipt of gift, either in cash or kind, these provisions are retracted. Of course, there are certain exemptions. That means under certain circumstances, the gift received will not be brought to tax. Now here, aggregate value of the cash gift received, if it exceeds 50,000 rupees, then whole of the amount is taxable. Now, the meaning of this term is that, now for example, I receive 10,000 rupees gift from say 7 people. So total gift received is 70,000 rupees. So aggregate, that is total value of this gift exceeds 50,000 rupees. So entire 70,000 rupees is brought to tax. Now let us look at the exemptions provided in the Act. Now the non-taxable gifts are the gifts received from a relative. Now let's see who is a relative in the subsequent slide. Okay. And any gift received during the marriage of the individual, that means during the wedding of the taxpayer, if any gift is received, that is exempt from taxation. Similarly, any gift received under will or inheritance is also not taxed. Okay. And then there is something called gift mortis causa. This is also called as gift in contemplation of death. Let us examine this in bit more detail in the subsequent slides. Okay. And of course, any gifts received from local authority like municipality, corporation, etc., or any gift received from charitable institutions like educational institutions or hospitals, etc., which are primarily or basically entitled to deduction under section 1023C of Income Tax Act. Then any receipt on account of amalgamation or demerger of companies is also not taxable. To see what is the meaning of the term relative, first, spouse or siblings of the recipient, that is brother or sister of the recipient. Then spouse's siblings, so brother or sister of the spouse. Then parents and their siblings, that is lineal descendants and descendants of the taxpayer, that is either parents or children, or their siblings like parents' siblings, or spouse of any of the earlier persons like either spouse of the siblings, then siblings of the parents, or spouse of lineal descendants or descendants, etc. So any gift received from all these persons are not taxable. Now coming to this gifts received in contemplation of death, there are certain conditions to be satisfied to be eligible for exemption under this clause. Section 191 of Indian Succession Act talks about this gifts mortis causa. Now according to this section, the gift must be of a movable property. So gift of immobile property is not covered by this. It's only gift of movable property. This gift is made in contemplation of death. Okay. Now what is the meaning of this term in contemplation of death? The donor, that is the person who gives a gift, is terminally ill and is not expected to recover from that illness. Okay. So, in contemplation, that is, it is expected that he will not survive the illness, and here the possession has to be delivered to the recipient. Okay. And the donee, the recipient, should not predecease the donor. After receiving the gift, the recipient should not predecease, that is, he should not die before the donor, and the donor does not recover from the ill health, because as the name suggests, it is in contemplation of death that is the gift is given. Somebody who is on the deathbed makes a gift, that is not covered by the provisions of taxation. Coming to this gift of movable property, okay, any movable property received without consideration, then how do we value this gift? Because earlier I said gift of cash or kind is taxable. Now the law says aggregate fair market value of the gift. So the fair market value of aggregate, that is, if I receive more than one gift, the total fair market value of all the gifts that I received will be taxable. Okay. This is of course subject to the condition that the total value exceeds 50,000 rupees, and once the total value crosses this threshold limit of 50,000 rupees, entire amount of the gift, value of the gift, will be brought to tax. Now, there can be a case where gift is received on payment of a small amount, a token amount. Strictly speaking, this may not be treated as a gift. Any movable property received on payment of a consideration, this is not a gift, but when the consideration is less than the fair market value and the difference is 50,000 rupees, then the difference is treated as income of the recipient and brought to tax. Now, for example, I buy a piece of jewelry for 1 lakh rupees, but its market value is 2 lakh rupees. Then the difference here being more than 50,000 rupees, entire 2 lakh rupees will be brought to tax. Of course, subject to the exemptions provided, what we discussed earlier. I said movable property. Now, what is the meaning of this term property? Here this section gives very exhaustive definition, because section says property means following capital asset. In other words, first of all, the item or the property gifted must be a capital asset. Then secondly, it must be one of the following properties. Okay? If it is anything else, it cannot be covered by the provisions of taxation. Okay? Immobile property being land or building or both. Then shares and securities, okay, jewelry or archaeological collections, drawings, paintings, sculptures, or any work of art, etc. Plus of course bullion. But what is interesting is that here this definition doesn't cover vehicles. That means suppose I receive a car as a gift, then maybe it's not covered by the provisions of taxation, because here the section gives an exhaustive definition of the term property, and because it says property means the following. So any item which falls outside this definition is obviously outside the purview of taxation. Now coming to immobile properties, any property, immobile property received without consideration, then the value for the purpose of taxation will be its stamp duty value. But if there is a consideration, that means if I purchase an immobile property by paying a consideration, but the amount of consideration what I pay is less than the stamp duty valuation. Stamp duty valuation is the guidance value fixed by the respective revenue authorities for the purpose of registration of the property. And if the consideration is less than the stamp duty value, then the excess of stamp duty value over the consideration would be brought to tax. Okay. Now, of course, this provision would be attracted if the difference of between the consideration and the stamp duty value is higher of these two, that is either 50,000 rupees or 10% of consideration. Now, what is the meaning of this? Now, for example, I buy a property which is valued at 4 lakh rupees, okay, but I buy it only for 3 lakh rupees. Now, I have purchased a property for a consideration which is less than stamp duty value. Strictly speaking, it should attract the provisions of these taxation under section 56. But here, what is the difference? It's 1 lakh rupees, and here, so it is more than 50,000. But it should be higher of either 50,000 or 10% consideration of the consideration. Now, 10% of consideration is 30,000 rupees, that is 10% of 3 lakh rupees. Okay. So, here if the difference being more than 50,000 rupees, the transaction attracts gift tax provisions. I mean income tax which is treated as income in the hands of the recipient. Now, if there is a possibility that for this purpose of transaction of immobile property, an agreement is entered into, and the final registration of the sale deed is after a lapse of say 6 months. In the meantime, the government has increased the stamp duty value. So, when I enter into an agreement, say for example, the stamp duty value is 1000 rupees per square foot. Now, next month, government increases the value to 2000 rupees. So, when I go to register the property, stamp duty valuation is 2000 rupees, but I had entered into an agreement to sell the property at the rate of 1000 rupees. So, strictly speaking, the consideration received being less than the stamp duty value, it should attract these provisions of taxation. But here an exemption is given. So, in such a case where there is a difference in the stamp duty value as on the date of agreement and as on the date of registration, then the stamp duty value as on the date of agreement is to be considered. But this is subject to a condition that the payment of the consideration should not be made in cash. It should be either account pay, crossed check, DD, or through electronic transfers, etc. It should not be through either bearer checks or DDs or cash. Again, the stamp duty valuation may not be accepted by the taxpayer. Now, when can this happen? Generally, stamp duty value is fixed with reference to a locality and not with reference to any particular property. Suppose there is a property in a posh locality and the stamp duty valuation there is pretty high, but there is encroachment on that property. So, actual market value would be less for that property than the stamp duty valuation. Okay. Now, how do we proceed in this case? So, the Income Tax Act says that in such a case, if the taxpayer does not dispute the valuation before revenue authorities, because he cannot dispute for the reason that the valuation for stamp duty is with reference to the entire locality, not for that particular property. But the valuation can be contested before the assessing officer, saying that this particular property has got problems like encroachment, therefore the valuation is less than the stamp duty valuation. So, in that case, the assessing officer has to make a reference to the valuation officer of the department, and whatever the valuation fixed by the valuation officer would be the final value. Yes, friends, that's what I had in this video. In case you have any queries or comments, you can please leave a comment. Thank you.